Hi there, I'm Christian Reither, and I wanted to talk about what I learned at Columbia Business School back in the spring of 2008. What I learned from 10 different speakers, 9 of whom were at my value investing seminar class, which was taught, I guess, by Bruce Greenwald, but it was more to bringing in speakers. That was the most important thing, or most interesting thing, and 1 speaker from my distress investing class. And this is not everything that these speakers said, and it's not all of the speakers, but it is the interesting nuggets that were new to me and that I still find interesting over a decade later. In part because these are interesting things, and in part because I'm like, wow, is that actually where I learned that thing? I thought that was my idea, but here it is that I can now attribute it to specific people, not always who I thought I could attribute it to in my memory. Let us begin with Bill Nygren of Oakmark, which is Harris Associates. He spoke to our class in late February of 2008, and he's the first speaker that I have, and we'll go in chronological order thereafter. What he said that stuck out to me was that over a 5 to 10 year period, the management running a business that you own will make at least one significant decision that impacts shareholder value. So you want to know, how do they make decisions? You want to be able to trust them to make these good capital allocation decisions. And this is the first note that I have of, hey, you shouldn't just pay attention to the business and its moat and its sustainable competitive advantage, but you should also really pay attention to the management, because they are going to do things that are very important to how this turns out for you as an investment. And I think that this might be where I first learned that, which is cool. In the 2020 hindsight department, he also mentioned that he wanted to have metrics that he looked at that are different from what the rest of Wall Street looks at. So he gave the specific example of looking at branch deposits per share, or retail deposits per share at the bank Washington Mutual. And again, this is late February 2008, only a few months before Washington Mutual would fail and be taken over by Chase. But here we have a legitimate value investing legend talking about actually the wrong metric to look at for that. I didn't know it at the time, but neither did these value investing legends, and that is a theme that I noticed when I was reviewing my notes. Second speaker, Mason Hawkins of Southeastern, which is Longleaf. Several of the other speakers in my notes specifically called out Mason Hawkins as a great investor, which is cool. And reading my notes, I like this guy. He comes across with a sort of folksy wisdom like Buffett, but he's got a little cowboy twang to it. And I have my notes that he recommended a book, Don't Squat with Your Spurs On. And I don't want to say that with too much of an accent, because I'll just sound like I'm being rude. But that was a source of insight for him, was this book, which is a sort of like folksy cowboy wisdom. He said a lot of interesting things that I now know to be sort of straight up Buffettisms. Sort of like Bill Nygren, he talked about how you should judge management, and this is straight out of Buffett. You should judge management by their ability to operate the business, but also by their ability to allocate capital. And Mason Hawkins focused on how they do their repurchase decisions. Do they repurchase stock? Is it a good decision? That sort of thing. Again, this is helping me over a decade ago learn to focus not just on businesses but also on management. In assessing management, look at their share repurchase decisions. He also mentioned Sidney Homer, which is probably the first time I ever heard that name, and maybe where I learned about the history of interest rates, which is an interesting book about, long run interest rate history. Great stuff from Mason Hawkins, but a lot of it is really similar to Buffett, which is a theme that came through again and again. A lot of these people definitely worship at the temple of Buffett and have learned a lot of the lessons that Buffett has taught us. One more thing on Mason Hawkins, he did give 6 requirements for being a good investor, and I thought these were good. They stand the test of time. First, you need to have a sound philosophy. Second, you need to have a good search strategy. Third, you need the ability to assess management and assess competitive advantage. 4, you need the discipline to say no when something does not meet your criteria. 5, you need the patience to wait for those opportunities that do fit your criteria. And 6th, you need to make sizable investments even when nobody agrees with you. I thought those were 6 good pieces of wisdom. Let's move on to the next speaker, who is Li Lu. obviously famous investor, could have been managing money for Berkshire Hathaway, but he decided to continue to run his own fund at Himalaya. What stuck out to me of what he said is, one, he asked our class, what are the 3 tenets of value investing? And I remember sitting in the class being like, what are they? I know these, but what are they? And another student answered, they are, you value businesses, and that's how you get the value of the share. That's what you look at, the value of the business. Second, you look to Mr. Market as a source of opportunities, of information about price, but not for information about value. So if the stock price goes down, that's not telling you something. It's just giving you an opportunity to buy at a cheaper price, other things equal. And third, you always want a margin of safety. So he was the first guy that I have a record of writing down, clearly giving me those 3 things and saying, like, this is what we do as value investors. The second thing that pervades my notes, which I find interesting, and maybe it's because it was early 2008, is that Lilu was talking a lot about uncertainty, like about the difficulty of knowing what's happening now, and certainly the difficulty of what's going to happen in the future. So he talked about how you need to have a framework for understanding why people are doing nonsensical things, because otherwise you will begin to doubt yourself. He talked about you never know how things are going to work out, so you need to act despite the fact that you don't know and you can't know if it will work out, just you know that the odds are in your favor. He says that when you research a business, 2 things happen quickly. A, you realize that you don't know what this business is worth, and you can't figure it out. Or B, you figure out that this business is not a great business, and you move on in either case. So again, you can't know everything no matter how much work you put into it. And finally, that because values are uncertain, you have to assign a range of values to anything that you look at. And you buy, again, when there's a margin of safety, even to your range. I think this is interesting. Like, this is a guy who Charlie Munger invests with. He clearly knows what he's doing, but he's talking all about uncertainty and his limitations as a person and as an investor. Third thing that I got out from him is he said that it's a good discipline to value a business before you know the market price. And I'm reading this, I'm like, is this where I got this idea that's mine? Great provenance. So those are the specific nuggets of novel information that I got from Lilu. I did watch a video of him talking to the same class in 2006, a couple of years ago, and I got a lot more out of that than I got out of my own notes from 2008. So either he gave a much better presentation in 2006, or I really wasn't able to soak up what people were giving me in 2008. I think the latter is more likely, but yeah. You should watch a lot of these things if you want to learn more, because there's very good information there that I, back in 2008, was not absorbing and certainly didn't write down. Next speaker was Beth Lilly, who at that time was at Gabelli, now runs her own thing out in Minnesota, which is Crocus Hill Partners, and she also runs money for a wealthy family out there. So she said, following up on what Bill Nygren and Mason Hawkins had said, she talked about how you want to assess management by looking for disciplined capital allocation decisions. And she went a little bit further in defining what she meant there. She said she looks at return on capital and she looks at their reinvestment decisions. So Mason Hawkins said look at the price at which they repurchase shares, look at their repurchase decisions. She's saying look at the returns on capital, look at all of their reinvestment decisions, like however they allocated capital. Which again, I think helped the younger version of me to really not just, hey, I should focus on management, but how do I focus on management decisions? Not just repurchases, but broadening the spectrum to look at returns on capital, which I think is really cool. Like, I had forgotten about this speaker, and she taught me this. She also taught us about going to annual meetings, which is my thing, like a thing that I like to do. But she talked about how she had gone to the Pittston annual meeting to buttonhole the CEO and several board members because she was worried about the turnaround being stalled. And reading this, I'm like, oh my gosh, like this is not just this idea that I came up with, this is an idea that I learned from Beth Lilly back in 2008, and I forgot who taught me. She also talked about how when she set up a partnership, an investment partnership with two other managing partners, that the investing side was fairly straightforward, but it was the conflict resolution side where, quote, they almost needed counseling to figure out how to manage conflict between the three of them, which rings true to me that the investing side of the business end of investing is fairly straightforward. It's all the emotions and dealing with people stuff that can trip you up as a good investor. The next speaker was Bob Bruce. Warren Buffett selected him to be the investment manager for Fireman's Fund when Fireman's Fund IPO'd out of American Express back in the 70s. It must have been 80s. Jack Byrne was the CEO. Bob Bruce was selected as the investor. Beth Lilly was actually a mentee of Bob Bruce's. And Bob Bruce was interesting as a speaker because he had spent the past few years before talking to us really trying to understand himself and how he invested, because he was planning to retire and pass the reins on to his daughter, and he wanted to be able to impart as much wisdom as possible to her. And so he had a excess of specific advice that he could give to us at the time too. So he was very specific in describing his search algorithm, as he called it. And this might be where I got the idea that I should be very explicit about my own search algorithm, which I find interesting because I had forgotten about Bob Bruce too. His search algorithm was he wants companies that have had 10 plus years of high profitability, of consistently high profitability, with stable or better than stable market shares. He wanted a greater than $1 billion market cap. He wanted, his universe was Value Line. Remember Value Line? Yeah, I don't really either. And he wanted to pay as little as possible for growth. And this is fascinating to read in early 2019 because 10 plus years of operations, Value Line, and paying as little as possible for future growth are all things that seem decidedly out of touch 11 years later. And that maybe says more about 2019 than it does about Bob Bruce in 2008, but I find that interesting as well. He also said, he gave us this advice for listening to other speakers. He said, really home in on what their search strategy is for finding investments and how they value businesses. Because as he said it, these people will talk and talk and talk. People will talk and talk about everything, and they'll talk right up to the line where they're about to tell you their search strategy and about to tell you how they value businesses, but they don't ever get into those details. But those are, critical details, which I thought was interesting. Back to the 2020 hindsight department, he compared Motorola and Nokia as a bad business and a good business. This is 6 months after the iPhone was introduced, but neither he nor I at the time, because there's nothing in my notes, knew or understood that Apple's iPhone was going to completely upend Nokia and Motorola and all pre-existing cell phone manufacturers. So again, that's kind of interesting that major earthquakes can happen and smart people don't know it even 6 months later. Another piece of advice that he gave us, which I found very interesting, was to read several years of annual reports, of shareholder letters in the annual reports, because you want to find consistency. And he said that normally you find absolutely no consistency at all. I think this is really fascinating. I know that I learned that from Professor Laura Resnikoff in Turnaround Management, but here I have it in my notes as somebody else telling me exactly that information. I'm still going to believe that Professor Resnikoff told it to me, but Bob Bruce definitely told it to me. Maybe as well, maybe instead. So this is why we make notes, because my memory, at least, and maybe yours, can get squidgy even in less time than 10 years. Next speaker is Doug Millett. This was not in Greenwald's class. This was in my distressed investing class. And Doug Millett is the only short seller who came to talk. He is, to the extent that he's known, and he should be well known, he found Enron at Synecos. So he found Enron. And he gave an origin story at the beginning of his talk, which to this day is my understanding of what it takes to be a good short seller. He said that when he was 10, he went away to summer camp, and when he came back from summer camp, his parents were divorced and his father had moved out of town. And after that, he didn't trust anybody. And I heard this, and I still have this in my head of, it takes that kind of fundamental doubt or, just inability to trust other people. That gives you a real edge as a short seller, and I certainly don't have that. I grew up, happy and loved with no trauma like that as a child. which is a severe disadvantage for me if I ever try to do short selling. An interesting story and useful for him in his career. Of the things that he said that were interesting about short selling, he said that you have to play the other guy's cards. So he wanted to always understand why the owners of the stock owned it. It didn't have to be a smart thing, but he wanted to understand why it was so that he could see maybe when they would be shaken out. A twist on that, and not quite consistent, but I think it doesn't sound quite consistent, but I think it is consistent, is that he said that the person buying from you when you short stock is very often a very intelligent person, and you can't worry too much about that. What you have to do is you have to do better work. And the example he gave is like, hey, when you go out to visit Buffett in May, like ask him about the US Airways stock that I sold him. So everybody makes mistakes. You want to understand why your counterparty is buying this stock that you think is going nowhere but down, but you can't, lionize them so much that you think you distrust your own work. You just have to do great work. He said to watch the debt markets, because occasionally the debt markets or the debt will sell down before the equity sells down. And so you can get a signal that like, hey, things are starting to happen here that are not good. It's a good time to short. Or this is a good target for shorting. On talking to management, I love this quote, and I think this is why I don't like to talk to management until after I have a very clear view on a company. He said, you lose half your money talking to the CEO and the rest when you talk to the chairman. So like, these are professional salespeople. They'll talk you out of your doubts. So don't talk to them until you're very, very clear on your view. He said of the SEC that they are archaeologists, not detectives. So you can't rely on them to protect you from a fraudster. They will dig up your body many years after you are killed, and then they will identify the guilty party, if they ever do. I think that's a good way to think about what the SEC will do for you as an investor if you're looking at frauds, or as a short seller. On sizing, he said that they ultimately decided that 5% was a very large short. Otherwise, it was just too difficult emotionally. He said the pain threshold was too high, that you would get screen lock, because these, as they go up, they get bigger on you, and it would be terrible, and you wouldn't be able to think straight. Thought that was very wise. The last thing that I thought that was very interesting from what he said was his advice to us, and what was most difficult for him to impart to younger analysts was that there is no correlation between the amount of work you do and the quality of an investment. And what he meant is you can do weeks and weeks and weeks of work on a specific company, and there can be no investable outcome that comes out of that, and you have to be fine with that. Just because you've done a lot of work doesn't mean that you should put money on the line. And I think that's a great lesson. It's said a little bit differently by other investors later, but that's Doug Millett, great investor, gone too early. Thomas Russo. He is known for a lot of things. A lot of that wasn't new to me back in 2008, all about franchises and Heineken and Nestle. He's great, but what I did get from him, what was novel back then, was that he said that he likes companies that are controlled by families. He likes to get to know the families, to understand what they're going to do, but also the fact that they are controlled by a family is very good evidence that this is a cash-generating business, this is a good business, that this is a durable business, and so you have a greater comfort that this will continue to be a good business, just because it's been able to survive so long in a controlled way. The next speaker was Glenn Greenberg, and this was on April 8th of 2008. And Glenn is interesting because he was the only speaker who consciously mentioned the word crisis, at least in my notes. So this is again in April of 2008, less than 6 months before Lehman fails and everything fell apart, but until Glenn Greenberg, no one had mentioned crisis. And so what he said is that the current crisis is a great time to learn what not to do in investing. And I don't think I picked up on that at the time. I certainly didn't start selling everything that I owned. What he did say that sticks out aside from that is that his investment style at Chieftain was to look at 30 to 50 stocks that he would like to own at any given time, and to have that updated all the time, and then own 5 to 10 of those stocks. And what he did is he would look at the IRR if he owned it forever. Not sure how you do that, but he did that, and he would buy when he got a 15% IRR, and he would sell when he got a 10% IRR. And this sticks out to me because it reminds me of Alan Meacham's style at Arlington Value, which to me is having this database of outstanding businesses, knowing what they're worth, And when they're cheap, you buy them. When they're not cheap, you sell them, if they're not like super stocks. So that was neat from Glenn Greenberg, at least novel. He said a lot of other things, but these are the things that stuck out. Penultimate speaker that we'll talk about today is Andy Weiss. One thing that stuck out was, if you feel something in your gut, analyze if the opposite is true. He said that you need a personality that would rather be ostracized and right than lauded and popular. On that sort of topic of what you're looking for in an investor, you want someone who looks at the task of investing dispassionately. So they're looking at it as a homework problem. They want to get the problem done right. They don't really care so much about the outcome. I like that sort of craftsman mentality when it comes to doing your work as an investor. He wouldn't talk about SPACs. The way I remember it, and again this is a decade later, is that Bruce Greenwald asked him about SPACs. Andy Weiss said, no thank you, I'm not going to talk about that. Probably knowing that maybe 10 years later someone would make a video about it. So later Greenwald talked about, and so this is hearsay 10 years later with a foggy memory, that Andy Weiss would buy 22% of a given SPAC because you needed an 80% supermajority to push through any acquisition that SPAC would eventually make. And then when the SPAC wanted to do a vote to affect its merger, the whole purpose of a SPAC, he would go to the management and say, hey, I own 22%, I will vote no unless you buy me out at a premium. And that was a good way to make money with no downside. Looking back at it now, this might be why I don't touch SPACs, why I have a bad feeling about them in general. I'm not somebody who's going to go out and buy 22% of them and like use that hold-up value on somebody else. So it's probably best if I don't play in that space at all. At least that's the way I've looked at it. Maybe thanks to Andy Weiss way back in early 2008. Now our last speaker was Seth Klarman, at least the last speaker that I have novel insights to share. And he said a lot of things that I wrote down that I think were interesting, that is interesting to me because I don't get as much out of reading Seth Klarman stuff now, but I got a lot out of him talking to us back in 2008, and maybe that's more about the style of communication or where I was at the time. So he said that when you enter investing or the stock market is extremely important because it determines how you view risk. And so he entered the world of investing in 1979, working for Max Heine, or however you pronounce it, and the world at that time was super volatile, interest rates were super high, inflation was super high. Klarman talked about how there was a attempted corner in silver, I think by the Hunt brothers. So it's just like a very crazy time. And so as a result, he has a very strong focus on risk management. And so he said he has two jobs as an investor. The number one job is risk aversion, and the number two job is to identify value. So number one is risk aversion, and only then are you trying to identify value. And this somehow hits me a little bit more viscerally than just look at the downside first or look up first then down. Yeah, that's something that stuck out to me from what Klarman said. This may be where I first started to look at the downside value before I look at the upside value. I have attributed that to Joel Greenblatt, but Klarman, I have in my notes saying it years before I really dug into the Joel Greenblatt lecture notes and thought I got that lesson. He also said that your two constraints as an investor are capital and time. And so you really want to focus your time. And he wanted to focus, especially when he started working for Max Heine, on areas where they had an advantage, where there was some sort of structural benefit to going into it. So spin-offs and bankruptcy exits, etc., etc. And I find this fascinating because I thought that was my idea, but here it is, I'm learning it. I apparently learned it in 2008 from Seth Klarman. He said, and this echoes Andy Weiss, that your goal as an investor is to solve the problem. It's not about great investment returns. So again, this is sort of this mindset of the craftsman. It might be because Klarman is a portfolio manager and he's got all these analysts under him giving him ideas. But again, that idea of a craftsman I find fascinating. About SPACs, again, he's talking again, Andy Weiss, he said that they were, quote, reprehensible. He didn't like that the sponsors automatically get 20% for doing whatever. But he went on to say that the structure is interesting. Like you have the worst case scenario, there's no deal and you own treasury bills. That's pretty good as a downside. But then you have the optionality of maybe there's a good deal. And even now I find that flexibility interesting. The last comment from Klarman, or at least my last note from Klarman, is a great comment on being intellectually honest. He said that you should know what your thesis was when you went into the investment. So later, if the stock price is down, but everything is still intact, you can buy more. Otherwise, you should take the lesson, learn from your mistake, and move on. So unless the value is somehow still there, but it probably isn't, you should learn the lesson and move on. And I think that that was a great piece of advice then. I think it's still a great piece of advice, and probably something that I could do more to internalize. But I like that. So these are some of the things that I learned at Columbia Business School from the great speakers who came and talked to Greenwald's class, as well as the distressed investing class that I also had. I hope that me sharing some of these stories is helpful for you as well. And since you've stuck around so long, I wanted to say that I'll put up here or somewhere in the screen a link to a Lilu video, that Lilu video from 2006. I didn't want to put this earlier for everybody to see, because the more people who see this, the more likely it is to go down, because the internet works that way. Whenever I find some interesting video or piece of information, it tends not to exist a little bit later, so you got to seize these opportunities as they are. So here's the Lilu video. If you click on that, there are other linked videos which are of other speakers who I've mentioned and some who I didn't mention, like Michael Price comes to mind, speaking at Greenwald's Columbia class. So you can go direct to the source material, watch for the full hour plus of the talks that they gave, and maybe get even more than you got out of my talk right now. So that's my bonus for you. I hope you've enjoyed this video. I hope you've got something that you can take away. And if you like this video and want to see more when I come out with my next one, hit the like button, press subscribe, and I think there's a notification button that'll tell you when, at some point in the future, I do another one. So thank you so much. Have a great day. Bye-bye.